Everyone, welcome to the tax saving strategies for STR investors. How we're going to teach you how to save $50,000 to $100,000 or more in taxes, leveraging the STR loophole. So we've got Amanda and Matt here with Keystone. Thank you all for joining us.
Yeah, we're super excited to be here, Matt.
Thanks for having us. Yeah.
Hey, I've seen you guys a lot. I mean, y'all are constantly at conferences and doing all sorts of educational stuff. And honestly, it feels kind of like an honor that I'm even in front of you guys, like having this conversation, because I know y'all handle some big dogs out there when it comes from a tax strategy standpoint. I think y'all are working with Brandon Turner and my boy Michael Elefante and all sorts of other cool people. So I appreciate you guys coming on. I know I didn't know much about this whole tax thing when I first started investing. And, for new people out there, it's pretty complicated and can be kind of scary, but that's why y'all are going to break it down for us. And it's actually not as scary as it looks. It's just, you just have to have the right information. So appreciate y'all coming on.
Yeah, thanks for having us.
Well, awesome. Well, we're having more people join us each second here. And so we'll go ahead and kick off as we get more people coming in. And so, again, this is a presentation from Strike and Keystone CPA, where here, I'll just do my introduction real quick, and then we'll dive into it. So I'm Matt Sanderson. I'm the CEO and founder of Strike, STRIQ. And we basically are the Zillow for Airbnb investors. If you're going through the pain of Zillow, Airbnb spreadsheets, we've solved that problem where we've got a technology that instantly reveals the best properties to buy really anywhere in the country and maximize your revenue. And so it's a fun tech if you want to get out there and find profitable short-term rentals. And then Amanda and Matt would love for y'all to do a quick intro if y'all don't mind.
Sure. My name's Amanda Hahn.
I'm Matt McFarland. Our firm is Keystone CPA. We are based in Southern California, but we work with investors all over the country. Our specialty is working with real estate investors to help them proactively save on taxes so they can keep more of their hard-earned money and keep reinvesting and building their wealth.
Yeah, we're excited to be here to be able to share some of the ways that everyday investors can utilize short-term rentals specifically to save on taxes. And just to clarify, our clients are not all investors. They are people who, could be someone with high income working a tech job or a physician. We have other CPAs that we work with, but the underlying theme is somebody looking to build wealth in real estate rather than just paying taxes every single year.
Yeah. Again, when I first started investing, I kind of stumbled into this in 2020 and bought my first one. Ended up being a great return. And then I found out 2 years later that you could do these massive tax write-offs. And I was like, why did someone not tell me this sooner? And so anyway, yeah, excited for y'all to be here. I've got a story about that I'll tell. Can y'all see my slides up here, by the way? So quick story, and then we'll dive in and let y'all kind of break down the whole tax strategy. So once I understood and figured this tax thing out, I had done some cost segregation studies for a few of my other properties. And last year, I had a big tax problem. I was going to have to pay like $75,000 or $100,000 in taxes. And it was getting closer to the end of the year. And I reached over to my wife. I was like, hey, babe, I think we've got a tax problem. And she's like, what? And I'm like, I think we're about to cut a big check next year. And she's like, well, what are we going to do? And I said, well, I think we need to buy another property. And she goes, another property? We already have 4 of these or 5 of these things. Another one? And I said, well, it's either that or we give the government more money. And she said, okay, well, let's start looking. So we got on our technology strike and ended up finding and evaluating this property that you see here in Fredericksburg, Texas. It's 6 acres. It's got 7 bedrooms and a barn. It was $1.5 million purchase price, negotiated down like $4.45 million. We actually did not feel comfortable buying that on our own. And so we used our technology to actually put together pro forma. And I sent a text message to my future mother-in-law. And I said, hey, what do you think about this property? And she goes, oh, that's awesome. I actually just sold my company. I'm going to have a tax problem. Would you want to partner up? I don't know this STR thing. And I said, well, I don't know. Would you want to partner up? She was like, let's do it. And so literally with a few clicks of a text message, we ended up buying this property at the very end of the year last year. And now I'm going to get about 75 to 100 grand in tax savings. And she will also get about 75,000 to 100 grand in tax savings. And it ended up being close to the down payment for the house. And so anyway, it's just a great example of like what I've done personally. And again, it took me years to kind of figure this out and learn it. And now I would love to hear from Amanda and Matt of like how you can actually break this down, and other just normal people like me can leverage this for their benefit as well. So I'll let you guys share your screen, and then you can break it down for us.
Yeah, for sure. And I mean, I think for some of you, the story might seem sort of crazy or outlandish, and we hear that all the time. You know, is this legal? How does it actually work? Does it only work if you have a large income? Because one of the things you hear people talk about is the short-term rental tax loophole. So we're going to go over exactly what that is, how you utilize it, and we'll have a case study on that as well. So
Awesome.
like, you know, we saw Amanda and Matt, same as your Amanda and Matt over there. One of our passions is really in educating people on the power of real estate, not just as a wealth building tool, but also when it comes to tax savings. So you may have read one of our books on Amazon or heard us on different podcasts, from Bigger Pockets to NBC News Radio. But we're super excited to be here because taxes is actually one of our biggest expenses for most Americans. The taxfoundation.org, which is a nonprofit organization, they do a research every single year. And year after year, the results are that the average American loses more money to taxes than we do on food, clothing, and housing combined. So super crazy when you think about, you know, how much we're losing. I know a lot of people right now, we're right about to hit April 15th. People tend to think about taxes as what I owe on April 15th. But for most people, you've actually already paid in way more taxes through your regular paycheck than what you may or may not have to pay by April 15th.
Yeah. And even though it's like taxes are people's biggest expense, single largest expense most people are paying, almost no one's actually taught how to think about it throughout the year. They're thinking about it April 15th, right? But they're not taught to challenge it, question it. Most people don't plan around it. It's kind of just, hey, this comes up every April. I'm going to write a check for what's happened already last year. And that's just the way it's supposed to go.
Yeah. And in fact, so the Journal of Economics came out with this really shocking statistic that if you make $350,000 of income, you lose about $5 million to taxes over your lifetime, which, if you think about it, is super crazy, right? You know, earlier Matt mentioned, you know, maybe $70,000 that was the check you'd have to write, but again, how much of taxes was already paid in, right, before that final and last check to be made. And so that's why we love real estate investing. I think it's no secret that real estate comes with tax benefits, right? We all know that. That's why wealthy people invest in real estate. That's why politicians all own real estate. But what a lot of people don't know is actually how to utilize real estate to save on taxes. Traditional real estate investment, typically we look at is long-term rentals, right? That's typical long-term rentals, multifamily, mobile home parks, apartments, you know, all the usual stuff. And the reality is, if you're someone who invests in the traditional real estate market, there are quite a few things you have to do before you can actually utilize the tax benefits against maybe W-2 or business income that's outside of real estate. Specifically, what that means is typically you have to be a real estate professional, which comes with many requirements, one of which is you have to have more time in real estate than your job, okay? And so if you're a single person making high income, very difficult to have more time in real estate than your job. If you are a married couple, both working W-2, again, very difficult to become a real estate professional. And that's where the short-term rental tax loophole comes in.
Yeah, because if you think about it, right, in that example there, if you're making $350,000 in income every year, you're losing close to $5 million in taxes. If you can reduce that by just 10%, right, that's $500,000 back in your pocket over your lifetime that you could use to reinvest. I mean, imagine the growth on that and what you could do for your family on just cutting that bill by 10%. We're not even talking anything crazy like 50%, which we'll go into an example where you can kind of see how the numbers can add up. But that's one of those things where it's important to kind of plan ahead and control what you can control and make those moves like Matt was talking about. Like, hey, I know I'm going to be writing a check here. What are the options? What are the things we can do? I don't want to just give the money to the IRS because we know what the return on that investment is, right?
Yeah. And so going back, what I said was real estate professional status, more time in real estate than your job, which is difficult. The reason it's called the short-term rental tax loophole is because unlike traditional real estate, you don't actually have to be a real estate professional.
Yeah, that's what we love the short-term rental loophole. The short-term rental investing strategy can be something that you could have a full-time job. You and your spouse could both have a full-time job, and it could be almost like a side hustle for you. And so it could be as little as you working on your short-term rentals 100 hours a year. It could be 500 hours a year. But the beauty of it is it doesn't have to be more time than your W-2 jobs. And so that's where it really becomes a viable and powerful strategy for a lot of our clients.
Yeah.
And one thing I want to mention real fast is,
yeah.
Again, I actually have a lot of questions for y'all. And I know people that are watching out there probably have a lot of questions too. So I want to make sure everyone knows in about 15, 20 minutes, we're going to have Q&A. So be thinking about questions through this journey as we're talking. Even feel free to send in the chat right now any questions you have. And that way we can spend about 10 or 15 minutes for Q&A later, because I have good ones too. So I want you guys to make sure you have a voice to ask Amanda and Matt any questions you have as we go through this. So Amanda, you can take it back over now.
Yeah, so Matt's mentioned he's got lots of questions already. So definitely get your questions in now to get in before his.
Better hurry.
So we've warned you.
Yes. So we're going to go over the rules of the short-term rental tax loophole in just a moment. But, before I go to the rules, I think it's always good to go through what that actually means. Well, what is the benefit, right? What could I actually get if I invested in short-term rentals? How do we utilize it for tax purposes? So we put together a case study here with our clients, and we've renamed them just for privacy purposes. So we'll just call them
Amanda and Matt. Seems like a good theme today.
No, I've already renamed them on my slide.
Sorry.
Okay. All right. So we have Dan and Jenny, both physicians. So Dan is a urologist and Jenny is in academic research for medical research. So combined, they both work W-2 jobs, combined about $980,000 of income. Okay. And so typically their taxes, just generally speaking, without any strategy, about $281,000. And again, this is not just what they pay in April, but this is all year long withholdings, estimated taxes. So for Dan, his colleagues talked a lot about short-term rental loophole and investing in short-term rentals. But when he brought up that idea to his CPA, they actually told him, no, you don't really get any benefit from investing in real estate. Okay. Some of the things that he was told was the only way for you to really reduce taxes on, close to $1 million worth of income, two main things. One, continue to fund your 401k, right? A lot of you probably heard that before. And then two, donate to charities, donate to church and things like that. And although those are all really great strategies, right? Of course, we want to save towards retirement. Of course, we want to do well by giving back, but we're not going to fund $1 million to retirement account, nor are we going to fund $1 million to charity, right? Those just don't work. And so the concept of, okay, how do we then really put a dent in our taxable income when it's close to $1 million is looking at investments. Government incentivizes us to do investing. So when Dan and Jenny talked to their CPA, though, about real estate investing and kind of all the different strategies and benefits that they heard, their CPA actually told them a couple reasons as to why it would not work for them. And we wanted to share these because these are common themes that we hear from other CPAs.
And trust me, I know you guys have a lot of you probably heard the same thing, right? Like, income is too high. You guys just make too much money to benefit from real estate. You've got a W-2 job. You can't take advantage of this because you're working full time. You're both working full time, whatever the case may be. And then also they talked about real estate professional. Now we talk about real estate professional. There is a time and a place where when that makes sense and when you can qualify and when you can't. But you don't necessarily need it all the time, as we kind of alluded to with the short-term rental loophole, right?
Yeah. So if you've been paying attention, you already know that at least two of these things we talked about, or the CPA talked about, is incorrect, right? Because when you invest in short-term rentals, you don't have to be a real estate professional. The term real estate professional only applies to people who who own regular, traditional, long-term or mid-term rentals. So here's a kind of a good point to note. If you are someone who invests in short-term rentals and your accountant, CPA, tax preparer is talking to you about any of these three things, how much money you make at your job, how many hours you have at your W-2 job, or the fact that you can't be a real estate professional, these are the three red warning flags that you're working with the wrong CPA. Why? Because in using the short-term rental tax loophole, we don't care about any of those three things. But what do we care about them? Well, what we care about is the fact that it is a short-term rental. And a short-term rental for tax purposes is any property where the average guest stay is 7 days or less. Okay, so make sure you write that down. Property where the average guest stay is 7 days or less.
And that's measured over an entire year. It's measured on a calendar year basis. So something we get questions about that all the time too. Does it start, when does it start basically? But it is based on a calendar year.
Yeah. And then the second requirement is you have to meet material participation. So there's 7 different ways to meet it. But the most common ones Matt alluded to a little bit earlier is if you and a spouse, if you're married, have at least 500 hours on the short-term rentals, then you can use the strategy. Or if you have at least 100 hours, but no one else has more time than you could also use short-term rental loophole. And the third one is basically you have more hours than everybody else combined. Right. So those are the only 3 requirements, and you have to only meet one of those 3, and then you'll be able to get significant tax savings like the one that Matt just mentioned earlier that he used personally. Okay. So let's go over the example, right? Again, when we look at tax planning, we're not just saying, well, let's give away all of our money to charity. Let's put everything into retirement account. We're looking at how do we build wealth and save on taxes. For Dan and Jenny, our clients, they didn't really have any interest in quitting their careers. They're physicians, right? They're not going to stop working and just like become a landlord full time. So real estate professional status wasn't really a good thing for them. They were also busy. They had their careers, they had kids. They didn't want a second job. They didn't want to have a full-time job investing in real estate. And they didn't want a large portfolio, but they did know that they have to build wealth in real estate, and they wanted to make sure they got the associated tax savings. So what we implemented with them was the short-term rental tax strategy, exactly like the one that Matt just mentioned earlier.
Yeah, and the beauty of this is with vacation rentals like Airbnb, Verbos, that kind of thing, you can strategically create losses on paper through maximizing write-offs, maximizing your depreciation deductions, such that you're creating a loss on paper for tax purposes. And then we're being able to utilize that loss to offset against W-2 income, interest, dividends, capital gains, whatever other income you have. That's the benefit of the short-term rental loophole, is that we're not saying we want you to go out and lose money, obviously, but we're looking at how do we strategically create losses on paper and utilize and deduct those losses against our other income.
Yes. And I love that you said that, because that's the key, guys. We don't want to go out and lose money on properties. And that's why strike is so important. It's like we got to find good properties. It's never a good idea to buy bad properties for the tax savings. That's not actually a thing. Okay. So back to Dan and Jenny, they purchased their first short-term rental property in the local mountains, about $800,000, $160,000 down payment. Okay, so pretty standard in terms of loan to equity ratio. Now, through cost segregation and with 100% bonus depreciation, generated about $304,000 of first-year deduction from the building, as well as furnishings and things like that. Also, go ahead.
I was going to say, for those of you who aren't familiar with what cost segregation is, with all rental real estate in the tax world, we are allowed to take standard depreciation. We get to write off the building over a certain period of time. Long-term rentals, 27.5 years. Short-term rentals, 39 years. But with a cost segregation, it's actually an engineering study. Somebody goes in and looks at the property and says, hey, there's things in here that we can depreciate on it faster over 5 years, 7 years, 15 years. And then when we kind of supercharge that with bonus depreciation, some of those things we can actually write off all in the first year. That's where you see the power of the short-term rental loophole and leveraging a cost segregation study.
Yeah. The other beauty of being a short-term rental investor is that once you own rental real estate, you are a business in the eyes of the IRS. Okay. And by business, we don't mean like an LLC or corporation or anything like that. It just means you're in the business of real estate investing. And so for Dan and Jenny, they also got to start taking advantage of write-offs. Before, when all their income was just W-2, there was very limited write-offs besides 401ks and donations. But they were able to hire their kids, help pay their kids, take a write-off for it. They were able to start writing off the business use of their car and the educational money that they were spending in getting themselves educated in expanding their portfolio, right? Costs of different apps, costs of going to conferences. And because they met material participation requirements, they were able to utilize these tax losses, not just against the rental income, but against their W-2 and other income as well, right? So the key here is when you invest in real estate strategically, the goal is to create paper losses for tax purposes, but also actually generate returns on the property itself, right? So just to take a look at what sort of with and without planning tax differences, 980,000 of income, like we said earlier, about 298 of taxes due without any planning, right? With planning, their taxes were lower to 176,000. So that's a tax savings of 122,000 in just 1 year.
And again, we mentioned this earlier, right? This is all stuff that's legal. It's compliant. It's actually encouraged by the tax code. The tax code encourages you to be a business owner, to be an investor. They want you to do certain activities. And this is the way that you can strategically take advantage of that in the right way.
Yeah. And this is, we heard from Matt's savings, right? I think he said over 75,000 and more. Is that right, Matt?
Per partner? So yes, it was about 75 to 100 grand for me, and then about 75 to 100 grand for my other partner, which was a beautiful thing.
Mother-in-law.
For my mother-in-law. I got to make her happy, You got to keep family happy.
Yes. You got to make them happy. And this is another example, right? 120,000. And that's such a powerful savings, because without the investment, that's just money that would have gone to taxes. And we know what the return on investment is when you pay the tax, right? It's zero. There's no ROI for you personally. But now for Dan and Jenny, now they have this money. The 122 could be a down payment on another $500,000 worth of real estate. And so you kind of rinse and repeat. The numbers on savings we heard from Matt. The numbers on savings we have from Dan and Jenny are not anomalies. Here are a couple of other clients of ours that you can see on the screen with respect to tax savings. Tony and Sarah Robinson. You guys may know them. Tony hosts the Bigger Pockets Rookie podcast. Lovely couple of clients I've been working with for a couple years. Also started around 2020. Tony used to work at Tesla, eventually quit his job to grow their portfolio of Airbnbs. Over 1.5 million of income, where he paid zero tax effectively. Jesse Vasquez is another client of ours. He's midterm / short-term space, also very similar tax savings. And then also Michael Alafante, another client of ours that Matt had mentioned, saving very significant amount of taxes using short-term rental tax loophole, right? Now, these people are kind of the educators and thought leaders that we see on social media and on stage, but, regular investors get very similar tax results, right? Doing tax planning. And when we think about tax planning, it's not just about saving the money, but it's really about what we do with the money we save, right? Because what if we took the savings and we reinvested that money? What does that look like, right? Versus paying taxes.
Yeah, and so earlier we were showing an example, right, where Dan and Jenny saved $122,000 in that first year. But what if you saved only $10,000 a year? Over 10 years, that's going to save you $100,000, right? What if you would reinvest that money, use that as down payment and leverage on rental real estate? In 10 years, in our example, you could have almost $740,000 worth of real estate after 10 years using your tax savings alone to fund that real estate. Now, again, what if you do nothing? Well, you're going to, how much savings you're going to get in zero savings, and how much real estate you're going to have at the end of 10 years, you're going to have nothing, right? We all know how that math works, right? So
it's so sad. Don't say it like that. You have nothing.
But, let's kind of double it, right? What if you save $20,000 a year? At the end of 10 years, you're going to have real estate worth almost 1.5. Maybe you can supercharge, like we were talking about, cost segregation, buying additional properties. Maybe you save $50,000 a year. At the end of 10 years, you could have almost $3.7 million worth of real estate just using your tax savings as the down payment to get to that real estate. So we just wanted to kind of show this so you guys can really understand the power of it's not just we're talking about saving taxes. Yeah, obviously saving taxes is important, but what are we going to do with that money? How do we continue to make it work for us, right?
Guys, I might pause right there for a second because so Michael Elefante, he's actually a partner with Strike, and I've learned a lot from him. And you see his stories a lot on social of he liquidated his 401k and went all in on short-term rentals and liquidated all this stuff. Well, when you see something like this and the power of compound interest plus leverage and just real estate doing its thing, it almost begs the question of like, should you even invest in the stock market and all these other things when real estate is that powerful? I don't know. Fun question. Maybe we use that for the end, but let that be a teaser. Should you even invest in the stock market when real estate is this powerful? So we'll come back to that later.
Yeah. And I mean, from a planning today we're talking about one strategy, which is short-term rental loophole, right? But when we do tax planning with clients, there's a whole toolkit of different strategies we look at. And one other one to consider is, what if I can double dip on my money? I have money in my stock market. I leverage against that to buy more real estate with more leverage, right? That's how wealthy people build wealth, is utilizing other people's money to build your wealth and to save on taxes for you, right? This is the fun part of what we get to do all the time. So, all right. So you see the power of it. Like Matt said, if you don't save taxes, then you have nothing, guys.
You have nothing.
That's not what he meant. He just meant you don't have, additional.
Just rolled off the tongue.
But now that you've seen what's possible, the one thing to understand is tax savings comes with tax planning. Okay. How you save on taxes could be life-changing. Yes, that's all really good. But all of this happens with intention. Very few people just haphazardly buy property, happen to have the right hours, and then happen to have a great CPA who deploys all of those things, right? And so it takes knowledge, like what even Matt said earlier. Oh, I just happened to buy real estate. I didn't even know there were strategies associated with this until, later on, right? And so we want to make sure we understand the strategies before we buy the property, so we can buy the right properties with Strike and make sure we understand we're analyzing the right deals, and make sure we're doing the right things during the year so we can legitimately claim these tax benefits. Because what you don't want to happen is at some point, if you are audited, and not be able to prove that you did all the right things to actually earn these benefits. And here's where we see most people go wrong, is that most people overpay in taxes because they don't do planning. Again, everyone knows there's real estate tax benefits, but not a lot of people know actually how to implement the tax benefits.
Yeah, like I said earlier, right? Most people are just taught that taxes are something that happens to you, right? You send in your documents, you wait, you open the email with like one eye closed, like, oh God, what's going to happen here? Like, what's the bad news? And you'll ask that question, like, okay, well, why do I owe so much taxes? The answer is like, hey, you made more money, so you should just be happy, right? Like, it's a good problem to have. But there are better ways to do it. And I think that's where people fall short, is that they just don't realize that there's stuff they can do about it.
Yeah. So for those of you who are going to meet with your CPA soon or about to meet with them soon, if you're not happy with your tax result, schedule a separate time to meet with them. Don't try to cram it in like when you're talking about last year's taxes, because they don't have time for that, right? Schedule a separate meeting with your CPA to talk about planning. Like, hey, I'm interested in investing. I'm interested in short-term rentals. What are your thoughts about that? And we gave you the red flags earlier, right? If they were talking about real estate professional status or the fact that you make too much money, that's a sign that you may not be working with the right person. Or your CPA might be like, yes, I love it. Here are all the things that I think you should consider to reduce taxes for next year. Right. But again, try to have that be a separate meeting and don't squeeze it into like, well, by the way, since you're doing my taxes last year, right? Make sure there's dedicated space to talk about that. When we do tax planning with clients nationwide, one of the first things we do is to review their previous year's tax returns, because it tells us a lot about their financial situation. We're looking for opportunities for tax savings in the past. Unfortunately, over 40% of tax returns we review are not optimized for tax savings. So pretty crazy, right? And one of the reasons that such a high percentage of returns are not optimized, a big component of that is the short-term rental tax loophole not being utilized correctly, not being utilized at all. maybe depreciation not being optimized, right? And I think a lot of the times the reason is because people are just filing tax returns. They're reporting what happened in history versus doing things proactively on what could be done. And so what we did is we put together a tax risk self-assessment. If you want, you can scan this QR code and it'll take you to our assessment tool, which is a series of about 15 questions. It'll take you maybe 2-3 minutes to answer. Once you answer it, you will be emailed a score. If you score high, that's really good. So a high score is good. It means you have looked at most of the foundational strategies relating to real estate and wealth building. If you score low, that's also okay. What you can do then is print out your test results and bring it with you when you meet with your CPA next time and say, hey, here are the areas that I scored low on. Let's use that as our starting point in looking at what are the different things we should be looking at. Is it entity structuring? Is it depreciation? Is it how am I taking money out of my business? So you can check that out. But, one of the things I always tell people is you hear a lot of bad operators who will come out and say, hey, you should just buy properties even though they're not cash flowing and they're not doing well, because you get to save $100,000 or more in taxes. And that is the worst advice there ever is. And that's why we love the Strike platform. It is so important that you understand the numbers. And with any investment, it has to be a good investment first and foremost. And then the tax savings is basically the cherry on top. So with that, we'll hand it back to Matt.
Awesome. Well, thank you guys. I'm going to add my slides back to the screen so y'all can see this. Yeah, it's funny. I think it's a combination between bonus depreciation going back to 100% last year, and I don't know, maybe people just recognizing or just hearing more about this, and the fact that tax season is here. But I'm getting blown up by people like, can you tell me more about this tax thing? I've got a bunch of calls this week of they're trying to come to me for advice. I'm like, hey, look, I can guide you there. I can just tell you what I've done, but you probably need to go to Amanda and Matt because they're the experts on this stuff. So anyway, it just seems like there's a growing interest in this of now hey, I can get some massive write-offs. Speaking of that, I want to give one more case study and then we'll go into Q&A. This right here, I won't say his name confidentially for confidential reasons. But this is a true story of one of my buddies in Houston, Texas. He came to me, very similar situation to what y'all had mentioned. He's like, Matt, I've got a big tax bill that's going to be coming up. I've heard about the short-term rental stuff. I know that you've created this app that can help find these profitable properties really fast. Can you help me out? And I said, okay, well, let's jump on Strike, see what we can find. Literally found it in 2 minutes in Dripping Springs. It's 10 acres, 9-bedroom property. It was listed at $3.7 million. Actually, we negotiated down to 2.7, and then he bought it. Ended up buying it $2.245 million. So the market is ripe for great deals right now for you as investors to go just undercut sellers and just get in at really great entry points right now, especially before interest rates keep going lower. So just nugget, now's a great time to buy. And so he went and bought this thing. Again, $2.245 million. He put about $500,000 to $600,000 of capital into it so he could get to that upper range of revenue potential. And now, and would love for y'all to challenge me on this, man, since y'all are the experts. We think he'll get about at least $300,000 to $400,000 in tax savings, maybe more, potentially. I know it kind of depends on the land value and where his tax bracket is, but y'all can see here, this is what we're estimating what he might be able to get on this. And who knows, it might be on this lower end, but still that's $390,000 in savings or a refund that he might be able to get from buying this property. And best of all, so that's a huge return. That's like a 20 to 30% instant return on his money. Then on top of that, he's expecting to make $400,000 to $500,000 in annual revenue on this thing, which means at least $5,000 to $10,000 per month in net cash flow on top of that. And so when you compound this, the tax savings plus the cash flow plus the appreciation, now he's forced appreciated this thing that he might be able to pull out tax free. There's some crazy things you can do. So this is a real example of one of my buddies that utilized this really from a tax standpoint, and then found out that there's all these other advantages, plus having a really cool ranch and Dripping Springs that he can go to anytime he wants. So fun case study, and you guys can go do that too. Cool. So let's go to Q&A. I know there's a bunch of questions that people have been asking. I'll hold my questions for last. And let's dive into what some of these people have been asking. Amanda and Matt, can y'all see the questions here on the navigation bar, by the way?
I can. So
we can see the comments. I don't know if that's where you're have people asking questions, or is there somewhere else?
Yeah. Okay. I see a few. I'll go ahead and start answering some or asking these, and then you guys can start answering them. So sure. Olga, hey Olga, thanks for being on. She goes, when entering the STR business for the first time, how can I make sure the CPA I found is a good one?
Well, we gave you three major red flags earlier, right? So you kind of can gauge their knowledge. If they start asking you how many hours you work at your job, or how much your W-2 income is going to be, or talk about the fact that you can't be a real estate professional, those are red warning signs that they don't understand the short-term rental tax loophole. Good question to ask always is you don't want to say, hey, do you work with short-term rental investors, or do you work with real estate investors? Because 10 times out of 10, they're going to say yes, right? A better version of that question is, tell me a little bit about what your successful short-term rental investors are doing in today's market. And then just be quiet, let them talk, right? Are they sharing the kinds of stories that are of an investor profile that you want to eventually become? Or is it just, oh, well, my one client, they went away for the summer and they rented out their home on Airbnb. Like, no, that's not like a successful investor client story we're looking for.
Yeah. And I would just add to that, talk to other fellow investors, right? Like people that and are comfortable with, and have has some success, and who are they working with? That's always a good place to start too.
The number of times I've been asked, Matt, who's your CPA? It's like unbelievable. So it's just funny. So many people I think are not happy with their CPA, and they're craving a good one. And like you mentioned, well, I don't know if I mentioned this earlier, but I'll mention it. Not every CPA is the same. And so it's critically important that you have someone that knows what they're doing with this stuff. Okay. So Megan asks, okay, what is the cost of an STR someone needs to buy to offset about $50,000 in taxes? So is there like an average rule of thumb? Like if someone wants to save about $50,000, is there like some general guidance you can give to someone of like purchase price versus capital to put in as an STR?
It really depends. I mean, you could arrive at that answer through calculation, right? But so a couple of different things that you have to want to be able to answer first. Well, one is what's your tax rate, right? How the 50,000, what is that? Is that what you owe? Is that the total taxes? So we need to know, okay, what is the tax rate? What is your other income, basically, to get to that tax rate? And also, where are we looking? Right? If you're looking for properties in California, beachfront, we need a much higher purchase price to get to that tax savings. If we're looking in South Carolina in the mountains, maybe we can have a lower purchase price because the land value is lower. Also, we'd want to know rehab cost, furnishings, right? How much does it cost us to rehab if we're doing it? And how much in furniture, fixture, equipment are we putting in? Because all those we are able to take bonus depreciation on. Right. So yes, that is something that could be answered with all of the other facts provided.
And it's a great question because it is something that we actually work with and look at our clients with. So when we're working with clients and doing planning, and we have the answers to some of those questions, right? We know what tax bracket they're in. We know what income they are. What is their goals? What are they trying to save? We can back into that. And that's a common conversation that I think is really eye-opening for a lot of people, is that, oh, hey, with one or two short-term rentals, I can save $50,000 in taxes or $150,000 in taxes. And it doesn't take 5 properties. It doesn't take me working 2,000 hours a year. That's the power of that question for sure.
Yeah. So I actually pulled up this morning. Every morning we have a call with our tax strategy team here. And just this morning, because, right now we're filing tax returns for 2025. So two clients I just was looking at, software engineer and a stay-at-home mom, first short-term rental in Texas, saved about $155,000 in taxes last year.
Nice.
1.3 million in purchase and rehab and all that stuff. Another one was a real estate broker and spouse works for Meta. First short-term rental in Ohio, about 900,000 purchase price, saved 150,000 in taxes. So, it just really kind of depends, right? Texas versus Ohio, what your income range is, but these are not uncommon success stories.
One thing I've thought about that might just be helpful. Again, this is more of an investor view versus like CPA view. Just general rule of thumb. I've realized that I usually get about the same amount in tax savings that I would get as if I were to put 10% down, like second home loan. So like if I were to put 10% down second home loan on a $500,000 house, that's $50,000. Usually my challenge or the decision I'm making is either I'm going to give the government $50,000 for fun, not fun, or I can do a second home loan on a cool property that I found on strike on a beach or a condo or whatever on the lake. And I can do a second home loan there. And it's about $50,000, plus closing costs. And that roughly kind of washes out. I mean, again, those are just super rough numbers, but that's kind of generally what I've seen. I don't know. Maybe I'm crazy. What are y'all's thoughts, Amanda?
I mean, it really depends. We had a client this morning that was looking at a short-term rental in Southern California, and the numbers just don't work out. It's 25% building, 75% land, which is non-deduct, like you can't depreciate it. So it's much smaller. On the reverse, we have clients who buy short-term rentals with no money down, subject to deal, seller financing. So that's no money down. True. On a $500,000 property, still really great depreciation too. So a lot of that is on the creativity of the structure. And that's why I always tell people, like, it's rare to accidentally buy a property and accidentally meet the hours and accidentally do cost segregation and save a bunch of taxes. So much of this is intentional. Where should I buy? How should I buy? How should I hold title? When should I do the cost seg? How do I track my hours? Right?
Yeah, and that's a good point I want to bring up. Like my father-in-law's house on the lake, I think it's worth like 800,000 now or something like that. Between the improvements and what he bought it for, but the land value is like $200,000 or something like that. So you can only write off the actual improvements on top of the land. So that's a critical, important thing for people to know. It's not whatever the purchase price is of that property. It's you're taking depreciation on the actual improvements on top of that land. So you have to remove the land value from that. And then you can do the cost segregation study, bonus depreciation on that value. So just a heads up for people on that. Okay, so we have another question from Megan. She goes, if someone doesn't want the house to be an STR forever, when can they convert it to a midterm, long-term without causing an issue with accelerated depreciation?
So, yes, you can certainly, if you've got a long-term rental, midterm rental, and maybe the market's changed where that doesn't pencil out anymore, maybe you want to take advantage of the short-term rental loophole, you can certainly convert a property to a short-term rental. Doesn't cause any issues from a tax perspective while you're holding the property. Now, remember, to have a short-term rental for taxes and be able to utilize it, the average stay during the year has to be 7 days or less. And so you have to factor that in any conversion, right? If it was operating as a long-term rental for 6 months and then July 1st, you turn it to a short-term rental, that they're still going to look at the calendar year. So you need to kind of, be able to run the math and see, hey, is this really going to end up as a short-term rental if I, rent it out on an average of 2 days to everybody for the rest of the year? So that's something to think about. So sometimes the cleaner cutoff is obviously earlier in the year or like, January 1st or whatnot, right? But
yeah, so say someone say someone bought it this year and did a short-term rental, met all the hours and then got the cost segregation study and all that stuff and then got the benefit. And then next year decides, oh, okay, I want to turn it into a midterm rental. I mean, now they've already captured the bonus depreciation. Do they continue to get that even though they've converted strategy?
Mm-hmm.
Yeah, they can. You can change it vice versa too, right? You can convert it to a midterm rental, long-term rental next year. Doesn't undo the benefit you've already got. It's still a rental property going forward. There's still going to be some depreciation. You get to offset the rental income going forward. We generally just, because we get this question a lot in Q4, right? Clients are, hey, the year's gone by. I haven't bought as much real estate. I'm looking at closing in my short-term rental. But I just want to utilize the short-term rental loophole, and then I'm going to do it as a long-term rental in January. We don't necessarily recommend doing it right away in January. Maybe you let it play out as a short-term rental for a few months, because if you got audited, they do look at intention, and you want to be able to show that maybe it did operate as a short-term rental for a few months in the next year before the quote unquote market changed.
Yeah. What's really interesting is for most of our clients that do STRs, and depending on the house, of course, a lot of them are frequently a mixture of mid and short, right? So peak season, short, and then off season, maybe there's one or two midterm folks who come in. So that's not out of the ordinary. But if you are trying to use a short-term rental tax loophole for a specific year, you just want to be aware that the average guest stay does have to be 7 days or less, right? But in future years, it's not uncommon for a lot of our clients to have properties that kind of just go between the two, based on whatever gives me the most cash flow.
Yeah, no, that's a really good point, because I've got a college town property in College Station, and I know a bunch of other people are looking at college towns too, and they're like, well, during football season, I'll do short-term rental, and during the shoulder season, I'm going to do midterm. And I'm like, that sounds like a pretty good strategy, but, you got to be real careful if you're trying to get the tax write-offs that the average has to be 7 days or less.
Yeah.
Be aware out there. If you want to do that strategy, just make sure you're very particular on that. Okay, so Heath Holloman, what's up, man? Says, is the 1031 exchange the best way to eliminate tax burden if you sell the property that you have a cost segregation accelerated depreciation on? So thoughts on that?
I don't know if that's the best strategy. Whether it's the best or not depends on your unique situation. That is a popular strategy for sure. 1031 exchange doesn't really eliminate depreciation recapture. It just allows you to continue to defer the taxes on the gain. So yeah, that's one of the most common ones. There's other ways, for example, a lazy 1031, where you could just invest in other deals and then utilize cost segregation to offset it. We have clients who just naturally have passive losses, which may then offset recapture. But from a 1031 exchange perspective, we also have clients who sell, maybe let's say you're trying to use the short-term rental loophole. So maybe you sell a property that's a long-term rental, and you can 1031 exchange into a short-term rental, right? So that's also very flexible from that perspective too. So sell short-term, exchange into an apartment, or sell an apartment, exchange into a couple STRs. So very flexible.
Yeah. I was actually having a conversation with Bill Faith like a year ago on this topic, because I come from commercial real estate. And so it's always like 1031 exchange, because in commercial real estate, it's a different animal. So there's a lot of 1031 exchanges happening there. And so I just defaulted to the 1031 exchange seems like the best thing to do if you're going to sell and you've already taken a bunch of paper losses. Like, why would you not just do a 1031? And he was like, actually, like the lazy thing you just said, he was like, what if you just went and bought another short-term rental and just offset the taxes you're about to do because you just did another cost segregation study on this new property you just bought? So I was like, oh, I hadn't really thought about that. So there's all sorts of creative ways other than the 1031, it sounds like, to get around that.
Well, and to that point, right? Like, what's a reason why you might do that is because 1031 exchanges, there's time requirements, right? When you have to identify properties and close on properties. So there's a lot of stress there. There's actually studies out there too that show that people end up paying, I want to say, close to 10% more for properties they buy in an exchange because of those stress of the time requirements. So I got to close. So they pay more for a property than they should have. So again, you don't want to buy properties or pay more for properties than what the economics are telling you that it should be, because that tends to lead to a bad deal, obviously, right? Just to save on taxes.
Yep. Okay, let's see here. Does Keystone accept new clients? And if not, do you have any recommendations for CPAs who have similar specialization profile? This is from Julianne.
Yes, we're always taking clients. I will say that for all of our clients, they do come to us first and foremost with tax planning. The earlier you start planning during the year, the more opportunities you have. So right now we're in April, a really great time, especially if you're new to real estate investing, or if you're just looking to scale up your real estate. We still have time to analyze deals and buy good properties. We typically stop taking clients around November timeframe, because the reality is it takes a lot of time to purchase, get the loan in place, close, and put a property in service. So for those of you who are like, hey, I really want to save on taxes, I want to make sure I do the right things during the year and do planning, you can visit our website, keystonecpa.com, and we have a really great client onboarding team. They can talk to you about your income and what your goals are and help determine whether we are the best fit for you.
Awesome. And we'll have at the very end, we'll have some information where you can reach out to them if you do want to get connected. So we have got time for maybe a couple more questions, and I want to ask you a question. So I'm going to just jump in there. So what I've learned is eventually you're going to run out of your own money when you're investing in real estate. And so the sooner you can learn to partner with people, the sooner you can scale. Like y'all mentioned earlier, leveraging other people's money. So I'm to that point where I've kind of maxed out my own debt to income and my own cash and all that stuff. And so I started partnering on a couple of deals and seeing the benefit of that. But what I'm noticing is a lot of capital partners I work with, they want the tax benefits. So they either want to share in the tax benefits or they want all of it. And so there's a couple of things I'm thinking about as an investor, as I'm using Strike to find properties and, really unlock this. I can either do a partnership structure where we could just split it maybe 50-50, or maybe she could take 100% bonus depreciation and I take none, depending on the capital structure. But then there's also this GP-LP thing where it sounds like you can do depreciation for the LPs, limited partners, but they can't take active write-offs, right, on that. And so I kind of want to talk a little bit about partnerships and what are the best ways to do partnerships with these capital partners that are out there, like these dentists, doctors that are super busy. They're good at their jobs. They want to invest, but don't really want to think about it. And maybe they hit that 100-hour material participation, but they want, me or other people doing it all for them.
Yeah. I mean, definitely a huge planning opportunity, but a lot of landmines to be careful of, right? One of the things that you mentioned, the GP-LP structure, if we're talking about a syndication or a fund, by definition, the LPs don't have any rights. So very difficult for an LP to quote unquote earn the hours if legally they're not able to make any decisions.
But they would still get depreciation. It would just go against their passive.
It would be passive.
Okay.
Exactly.
Okay.
Exactly. So we rarely see that. I mean, we see that quite a bit just in the multifamily, storage, mobile home park world. Rarely see that in short-term rental realm. Why? Because for short-term rental investors, they typically want the tax benefits. So usually for our clients who are partnering where one person wants the tax benefits, you have to make sure that that partner, either by themselves or with their spouse, meet material participation hours. So we mentioned the most common one, right? They have 500 hours. Be involved in the day-to-day operations, or they have 100 hours, but no one else has more time than they do. And the other people that were includes you as an example. So you cannot have more time than they can on that specific property or that specific joint venture. So it's
that's been confusing because on the 100-hour thing, a lot of people are like, oh, well, as long as it's more than any cleaner or handyman or property manager, where it's like, as long as the partners are 50-50, there's a lot of gray areas here. And so I guess that just goes to show you need to sit down and do a tax, planning strategy with you guys to really dive through this. Cause you're right. There are a lot of landmines in it.
Yeah, right. Because if, for example, the other, you and I own a property together, on this property, at least, we can't both claim we have more time than anyone else, right? Because it's either you have more than me too, or I have more than you. But usually what we see in practice is if I'm the investor, I have more time than you, but you may have a bunch of other properties of your own too. And you can group all of yours together where you reach 500, right? So yeah, it takes a little bit more in-depth planning to make sure.
Okay, I'm going to give you all one more test or example to run through. So with Strike, we've got a bunch of customers that, some people have deep pockets and they're ready to go invest, but a lot of people are aspiring entrepreneurs. They've got a little bit of money, maybe 50, 100 grand, but maybe just not a whole lot to really get a great property and maximize it. And so their thought is, hey, I want to go find these great deals, but unlock these capital partners through these pro formas they can send. that they really take the time and the due diligence on. And so one strategy has been, hey, can we do a partnership with this capital partner and just give them 100% of all the depreciation as like the massive tax write-offs benefit for the capital partner? They just spend all the capital on the deal itself. And then the person that's on strike finding it puts in $0 and they do like a 50-50 structure. How could they do something like that? I guess they would just have, the capital partner would have to meet those hours.
I mean, yeah. So I think there's a couple things at play, right? So first is kind of like, how do we allocate income and expenses in the partnership? And then the second question is, if I'm allocating, as part of allocating expenses, includes depreciation. The second part is that capital partner put a lot of money in, they're getting a big chunk of that allocated to them. How can they utilize it, right? So there's certainly ways in the partnership tax world that you can structure deals like that where, hey, the capital person put in a bunch of money, so you allocate X amount of depreciation to them first until their capital is down to zero. Then you split it, 50-50, whatever, agreement you guys come up with. But then, it comes down to the question of, can they utilize it? That goes back to their own personal situation. Are they, they have other deals that they can kind of put the stuff together. They have other passive activities. Do they need to meet material participation? So a lot of things at play there, but certainly things worth looking into and ways to do it. And, another thing that came to my mind too, when we were talking earlier, is there's certainly capital investors out there that want to share an upside and equity and appreciation, things like that. But don't close the door on, there's capital people out there that just want to make money on their money too, right? And so if you can strike deals where, hey, I own 100% of it, but I'm paying you as a lender, you're getting your 6, 7, 8%. I'm still keeping all the appreciation. I'm getting the depreciation benefits. There's ways that we have lots of clients do deals like that too.
Yeah, that's a great point, because I've got a buddy who's a dentist here in Houston, and he just honestly likes lending at higher interest rates.
Yep.
He's like, hey, look, take my money all day long. I'll have a loan position on this asset that you go buy, and if you default, I'll take it over. But if you don't default, you just pay me interest, and that's all he cares about. And so that's nice for investors. Is the capital partner is just getting a loan on it, and then the investor gets all the benefits, which that is a beautiful thing. So all that to say, I think we're getting close here on time. I think we've barely just hit the tip of the iceberg of like all this incredible knowledge that y'all have. And so I appreciate you guys coming on. Let me just wrap up with a couple of house cleaning items, and then we'll wrap up here. Just want to let y'all know, we are launching something really cool, Strike 2.0, coming May 1st. So less than 30 days. We have been building Strike for like 4 years. We did a big $1 million seed round, and now we've basically rebuilt it in such a way that it's going to be super powerful and amazing. AI is going to be integrated into it, and it'll instantly reveal the best deals really all over the country for you to go buy. So heads up on that, that's coming. And then because of that, we are doing a 67% off for life situation for founding members. Normal pricing is like $2,000 a year. Right now it's like $799. So if you want to jump in, there's 100 spots, super cheap pricing for y'all to come in and start using Strike to find great deals. And then y'all can find us here at strike.com/join. So feel free to reach out on that. And then anything y'all want to wrap up with?
No, I think it's just like I said earlier, if you want to make sure you are maximizing your tax savings, especially through short-term rental investing, the earlier you start planning, the more options you have, right? And so we're still at a good time during the year where you can take your time to analyze deals and buy the right properties and do the right things to get the right tax savings. So check out the tax risk assessment to see what your risk is in overpaying taxes. If you're looking for free tax content, you can go to KeystoneCPA.com. I'm very active on Instagram as well. You can look me up for daily tax tips at Amanda Hahn CPA. And we also have a YouTube channel with Amanda Hahn CPA as well.
Awesome.
Thanks for having us, Matt.
Well, hey, we are on time. Look at this, with 1 minute to spare. I'm proud of us. So, hey, thank you all for coming on. We may need to do this again in the future, because this is, again, one of the biggest things that people come to us for. And I feel like we've just barely hit the tip of the iceberg on it. So we may be scheduling another time with you guys, because this was awesome. So thank you all for coming on, and thanks everyone for watching, and we will be back soon. Thanks everyone.
Everyone.
Thanks everyone.